All right, so let me get started. First of all, again, welcome to everyone, and thanks for making time this afternoon to be with us here today. We have with us today Connor Fitzgerald from JP Morgan, and he'll be on shortly. And Connor's going to enlighten us today about his firm's economic and investment outlook for the coming year. So I'm looking forward to that, as well as you guys. Of course, just a few housekeeping items at the beginning of our presentations today. So as you've already met most of you, Lisa LaPlante, my operations manager, and my paraplanner, Mike Whitney, are also on the call today. So if you have any problems with the presentation, viewing it, hearing anything, or any difficulties whatsoever, you can always call the office at 518-786-3300. Or you can email Lisa at llaplant@albanyfinancial.com, or Mike as well. And his email address is mwhitney@albanyfinancial.com. Lastly, we're really excited here at Albany Financial Group about our new podcast that we've launched. And we actually launched it last October. And it's going for, I think, 5 months now, Lisa. We just recorded our 5th show. It's called Invest in Knowledge, and it's a podcast about all things financial. And we're having a blast with it. It's a lot of fun. We've gotten good reactions to it. You can find it on Spotify, Apple, Google, or wherever you get your podcasts. And you can also find it at our website at www.jgigliello.com, jgigliello.com. Okay? All right. I think that's it for housekeeping notes on my end. So let's get started. Let's dive right in. So we're very privileged today to have with us Connor Fitzgerald. And as I mentioned, he's from JP Morgan Asset Management. Now, I know you've all heard of JP Morgan. JP Morgan is an international leader in the investment management industry. And Connor, I was checking the website out today. The firm has over 2.4 trillion with a T assets under management. So that's just amazing. Connor is a vice president and client advisor for JP Morgan Asset Management, and his role in the company is to serve financial advisors in the independent broker-dealer channel. That's where we reside, and he does that in upstate New York. He resides in Rochester, New York, and is responsible for delivering JP Morgan's timely insights and product lineup across, again, the upstate New York region. Connor has earned his bachelor's degree and master's degree from the University of Delaware, and has also earned the coveted Certified Investment Management Analyst designation. So Connor, again, thanks for making the time for us today, and I'll throw it over to you.
John, thank you for that introduction. I'm looking forward to hearing the podcast, and I really appreciate you having me here tonight. Great to be able to speak with you all. Hopefully you've been staying healthy throughout all of this. And look, we got a great conversation lined up for you this evening. Definitely a lot to talk about when it comes to markets. And most importantly, we want to be able to answer whatever's on your mind. So as John said, I get the opportunity to work with financial advisors across all of upstate New York, about 300 advisor teams that we have the chance to work with. And I mention that because I've had the chance to work with John and his group for a number of years now, and nobody better to help you guys navigate everything going on in markets in these days. So again, John, thank you for having me. We appreciate your partnership. So I'm going to share my screen here. John, can you see that all right?
Yeah, so it looks good.
Perfect. So folks, we've got an amazing tool here at JP Morgan called the Guide to the Markets. And as John said, being one of the bigger international companies around the globe, managing 2.4 trillion in assets, we get our hands on some really, really good data. I think the beauty, though, of our data is we're able to simplify it, take all these complex issues and simplify them in ways that we can understand, because it's so easy to get caught up in all the news that we hear on a daily basis when the data might actually be telling a bit of a different story here. And so that's what we'll do today. We'll separate the news from the noise. And what John and I thought we would do is just talk a little bit about JP Morgan's 2022 outlook, as well as just an update on recent volatility. Right, we finally have had some return of some bumps and some turbulence in markets, so we'll address that. And we'll talk to you about what the best investors are doing these days. And so the place I wanted to start was on one of my favorite pages in the Guide to the Markets. And maybe you've seen this when you're sitting down across the desk from John in the office. But this is a great page to remind you just how normal volatility is. Now, before diving into this, I want to just share with you a really quick story here. And the story is about the great Harry Houdini, who all of us have heard about at some point in our life, but you may not have heard about how Harry Houdini ultimately passed. And we know that he's a stuntman, he was an escape artist. And one of the things Houdini used to do is he used to get up on stage and call somebody from the crowd, who he would find the biggest guy in the crowd, and he'd ask him to punch him in the gut. And he would barely flinch, right? He was prepared for it. And so it didn't knock him off course at all. But there's one day where he's backstage with a bunch of students and he ultimately gets surprised. He gets hit from behind the back by just one of these younger kids, a student, and he dies the next day from a ruptured appendix, right? And that's ultimately how risk always works, right? It's always the thing that you don't see coming. I mean, think about this. This is a guy that was handcuffed, shoved inside a dead whale's body, and ultimately escaped, right? So you think about all the amazing things he's done, but it was the unexpected punch that ultimately it was what led to his demise. And when it comes to investing, that's often how it works too. It's never what we're expecting to derail our portfolios that ultimately does. So you have to be prepared for bumps no matter where you're at in the cycle. Perfect example is we were trying for 10 years to figure out what the next recession would be caused by. You know, would it be Obama's fiscal policies, Trump's trade wars, rising interest rates, you name it. And it was a virus, right? It was none of that caused the big sell-off that we had last year. So I wanted to share with you that, and we'll talk about time and diversification as the key aspects that we could think about as investors. But I also wanted to update you on recent volatility here. So the way that you look at this page is these gray bars that you see along the page, they represent the return of the market going back every single year to 1980. See, a lot of data here, about 21 years worth of data. And, you know, year to date, we finally have had the reintroduction of a little bit of volatility, as I mentioned. We've had about a 10% pullback thus far year to date. And the market is down around 5% or so year to date. That is much more normal than what we saw last year, which we only saw a 5% pullback. Right? In fact, if you look at the top part of this page here, what you'll see is that on average, the market actually drops about 14% in the year. So volatility is really, really normal. Right, but it ends up positive roughly 75% of the time. Right, so stay the course, especially when it's the toughest thing to do, is ultimately the big takeaway from this page here. Now, the other thing that we can rely on, and we don't have to do much here to rely on it, is use time to our advantage. Right, and I'm sure that John talks about this to you all the time, but over a really short time period, it's anybody's guess where markets end up. But if you start to look out 5, 10, 20 years, if you can, time has this amazing impact at diminishing the impact of volatility on your portfolio. And so let me illustrate that to you here. What you see up on this page are 3 different portfolios. Okay, and these 3 portfolios are an all stock portfolio in green, an all bond portfolio, very conservative in blue, and then you've got a 50-50 mix of the 2. And so again, if we look at 1 year here, it's a coin toss, right? Markets end up positive almost half the time, a little bit more shaded to the upside, but you could have big down years as well. That said, if we start to even just think about 5 years out, take a look at this. There's never been a 5-year rolling time period going back to 1950 that a balanced portfolio would have ever been negative, right? So that's through all the recessions that we've had throughout history. If you would have just stayed invested for 5 years plus, you would have ended up making money. And it's even more pronounced as you go out further. You can see the all equity portfolio over rolling 20 years. The worst you would have done was 6% annualized. So staying the course, diversified, or if you're more aggressive, riding out the bumps and doing the average thing when everybody else is freaking out in periods of sell-offs is the most important thing we can do as investors. Now, with that said, we want to sort of dive into what's going on in markets right now, because again, we've had some turbulence here lately. And the way that I would think about this is you've got some really good news and you've got some not so good news in markets. I would think about it almost like this investment seesaw here, where on one side, you have the positives. And that's a very strong consumer. That is a earnings environment where companies are profitable. And then there's this big trade-off between stocks and bonds. Those are all positives. On the other side, it's what we've heard about with inflation and rising interest rates. We think the positive side outweighs the negatives. So I want to share with you some of the data in here that we look at JP Morgan, starting with the first of that positive, which is the consumer. It's all of us on the line here. It's your family, your friends. We drive about 70% of economic growth. So growth in the US only goes as the US consumer goes. In other words, if we're spending money, the US economy is going to be in a pretty darn good shape. And we have a pretty high propensity to spend money. It's tough to slow down the US consumer, especially in really good times. Now, I'll share with you a statistic before we look at this. JP Morgan actually manages money. So 50% of Americans have some sort of bank account with JP Morgan Chase, which is pretty wild. If you think about it, across the country, 50% of Americans bank with us. We sit on a war chest worth of data. And we've never seen the consumer look more healthy than right now. What you're looking at is debt payments per household as a percent of income, just about as low as it's ever been. It ticked up recently because interest rates rose slightly. But that's in a really good spot. On top of that, if we look at net worth, what you could see is that net worth is up a lot since the beginning of COVID. If I would have told you we would have the second biggest recession of all time by numbers, which COVID actually was, took a huge chunk out of the economy, but yet Americans would have got roughly 25 to 30% wealthier on average, you probably wouldn't have believed it. But because of a combination of the stimulus money and forced savings, we're in a pretty good spot here for the consumer. So that should give a nice floor under this economy.
Hey, Connor,
Right ahead,
quick, not really a question, I guess, just a comment, see your thoughts. So the household debt service ratio, I would imagine a lot of folks are still stinging and still have memories of 2008 in their minds. And that may be a reason why that debt, you don't see it like you used to 14 years ago. People really got serious from that, and they started paying off all their consumer credit cards and things of that nature. Those two, you think those two are linked?
Absolutely. If you see how this trends down post 2007, John, it's exactly what happened. We started to get our act together, sort of a wake up call. Let's take the excess money. We still spend a large portion of it, but let's pay down debt as much as we can in really good times. And that's what we saw last year when people were forced to save a lot more. The amount of debt that was paid down was really amazing, even in the lowest FICO scores, John.
Yeah, interesting. Thanks.
Now, we've still got this virus lingering. We're hoping that you get past the worst of it, and maybe this is the last wave. But what'll be interesting to see is how that money's spent. One of my favorite pages, I love this page in the Guide to the Markets because it gives you real-time data on how all of us are spending money. And so you could see here, the economy was turned off back here. Right? We were all forced inside. We couldn't get on an airplane, so TSA traffic went down to zero. We couldn't go sit in a restaurant. That went to zero. We weren't staying in hotels. All these things collapsed, but you started to see this really nice rebound here until more recently with the latest variant. Spending is strong, 33% above where it was pre-COVID, but these other areas still have some room to run. We think you're going to see a real revitalization of people going out and being able to live again. It's going to be a transfer of where money's spent. We spent all of our money on goods over the last 2 years here. Maybe it was buying bicycles for your kids, buying a new car. ATV sales went up like triple last year. We think a lot of that will shift to services this year, which will give some nice upside to growth. If you're a numbers person, 3 to 4% growth for the U.S. economy, we're thinking. So that's really the first big positive here. The second big positive, which we'll hit on quickly, and if there's any questions towards the end on where we like within equities, we'll definitely hit on that. But we're going to hit record earnings again this year on the stock market. Right? If you look at this page, this is the S&P 500, the best proxy for where the market is going, most would say, going to hit a record high this year. And if you think about this jump from pre-COVID to where we're at now, just amazing. A lot of companies were forced to adopt technology faster than they ever have. And that technology really improved efficiencies and productivity. So it's not going to be a blowout year of earnings like it was last year, but still really, really strong. And earnings tend to drive the market over the short and the long term. If you're curious about the right side of the page, by the way, what this shows you is where the market's at and how it's being driven. So that's a little bit in the weeds, but you can see earnings growth is growing. Yet the price that investors are willing to pay for stocks, which is the multiple, think about that as more sentiment driven, has come down a bit. And we'll talk about what has caused that volatility, but it's starting to rebound a bit here over the last few days. Today was another really good day for the markets. So strong consumer, strong earnings have us feeling good. And then the final piece there is what we call the TINA trade, actually, TINA. And if you may have heard of this, the TINA trade stands for there is no alternative. Right? And if you think about it, where we're at right now in terms of interest rates, there really is no alternative to equities. So it leaves some good support underneath markets. And I'll show you that with a page that'll really blow your mind. You'll cringe when you see it, but if you think about what cash is earning you right now, this is $100,000 sitting in a CD. That earns you about $70 right now over the course of the year. You know, there was a time when you could have actually done something with that money. Think about 2006, $4,500. Maybe you could have taken your family on a vacation. Nowadays, I went to the pump and I filled up my Jeep. $91 yesterday, John. So you can't do much with what you would earn on cash here, especially when you think about this silent killer, which is inflation. That blue line there shows you what you would have needed in order to beat inflation over the course of the year. In other words, you're losing quite a bit when you're sitting in cash, which is, again, forcing investors back into equity markets, leaving us in a pretty decent spot. So I'd say those are the big positives here that we're looking at. John, before we transition over to, one or two of the headwinds here, any questions there from me on what we've covered so far? Things you want me to go a little deeper into?
I'm pretty good with what you've presented so far, Connor. However, there is one slide. It's a real basic slide. I think it's back further, maybe page 60 or 7. It's just the standard asset class diversification chart. There you go. Yeah, asset. And if you just a couple words about that, explaining that, and how important it is for those white boxes to show up. Because again, from our perspective, we do a lot of financial planning here. Investments are a component part of that plan. So again, we're not really market timers. We're not stockbrokers. We're not picking individual stocks and bonds and securities. We really value, diversified portfolio. So maybe you can speak a little bit to that chart for us.
Yeah, absolutely. The thing about trying to time any asset class, to your point, John, is you have to get it right on both sides. You have to get it right on the way out and the way in, or vice versa. And so we're massive proponents of diversification. Now, diversification is going to mean you always need to apologize for something, because you're never going to be at the top of the page, but you're certainly never going to be at the bottom of the page. So the reason I love this illustration here is what it shows you is in the middle of the page here, this is a well-diversified portfolio. Think about it like a balanced fund where you took all these different colors up, sort of like your kids were in the driveway playing with all the different paint, they mesh them together, you get that weird grayish color. That's what we're doing here. We're taking all these different colors for the multiple asset classes, putting it together for you. And the reason that's important is in really tough years, diversification held you in there, right? You had a much smoother ride along the way, and you ultimately ended up in a really good spot, earning almost 6% annualized. And that's through 3 deep bear markets along the way. We think that's paramount right now with the quick moves that the market's having. So I'm glad you brought that up, John. The other thing I would point out is, if we look at the tendency of the average investor, if they're not diversified, they tend to not make it throughout their entire investment journey. So a real quick illustration on that, what we showed you here was $100,000 invested in 3 different portfolios right before COVID happened. One of them was an all stock portfolio. The other was a 60-40 stocks to bonds, and the other was a little bit more conservative. What you could see is if you weren't diversified, you lost a lot more on the downside, right? It took you a while to recover your losses too, relative to the diversified portfolios, right? So you most likely didn't make it from point A to point B if you had too much risk. you probably made a bad move at the wrong time. And that's exactly what the bottom of this page shows us here. So a famous study by a company called Dalbar shows that the average investor tends to be really emotional. They pull their money out of the market at a time like this. They don't get it reinvested until they start feeling much better again, and they barely beat inflation over time. So I'm glad you asked, John. Maybe we touch a little bit about the headwinds here going forward that we're seeing.
Please do.
Okay. So look, we've started to hear a lot about three things that caused volatility this past week. Number one was a concern about the Federal Reserve getting much more hawkish or aggressive, as people would say. And that is in terms of raising rates. They would do that because inflation was high. So we're going to address that. We think that's the big one. Secondly, geopolitical noise, Russia and Ukraine, concerns about geopolitical risk. We think that's less of a risk to global economies. And then the final piece we actually already debuffed, which is earnings slowing down. It was a huge earnings week last week. Investors were concerned where they would end up, and they ended up pretty strong. So let's talk about the Fed and inflation. Elephant in the room, inflation has been soaring over the course of the last year, but we think it is set to come off the boil this year. This number right here is the price increase that you're seeing across the board. 7+% inflation, which is really, really high, especially when you think about it relative to history, which has been about 1.5, 2% in that range. So there's a couple reasons why we think this will start to come down over the course of the year. We've all heard, you can't turn on the news without hearing about supply chains right now. You may have ordered something. You might have a couch that's sitting off the coast of California right now. It's not uncommon. And we actually track this data. So what this shows you here are supplier delivery times. And obviously, as you can see, that skyrocketed over the course of the last year or so. Ton of demand, chasing goods that were bunged up in supply chains overseas. That is starting to ease a little bit. This is a survey of managers that are actually telling you it's getting a little bit better. We think that'll ease prices a bit over the course of this year. And then the right side of this page shows you that the prices for businesses, which are the input prices, really rose quite a bit. And they passed those right along to you and I. The output prices is what we're paying. That stuff is starting to come down just a bit. The other thing about inflation is it's all about the rate of change, right? It's all about how much more we grow from here. So you would have to have a really intense view on inflation to think that we're going to get another 7% growth this year in prices. We think you end up 3 to 4% and start to come back a little bit more towards normal. It won't be as much of a problem at the end of the year as it is right now from an investing conversation. That said, it has the Federal Reserve on watch to become a bit more aggressive here. And what they can do to stave off inflation is to sort of tap the brakes on the economy. And the way they would do that is by raising interest rates a bit. And you could see interest rates are at 0 right now. And we've been at 0 or close to 0 for a really long time. But it sounds like the Federal Reserve is going to raise rates at least 3 to 5 times this year. We would say on the lower end 3, and on the higher end maybe around 5 times. Now, for some perspective, the last 8 times the Federal Reserve has done this, and they've done it 8 times since 1983, where there's been a cycle of hiking, sort of like this, to raise interest rates. History won't always repeat itself, but it can often rhyme. And over the last 8 times, the market has been up the year after the first rate hike. So the 12 months prior, the market has actually been positive. So it's not necessarily a death knell for equities, especially when starting off a lower level. We think it creates volatility, but that's just it. Volatility and otherwise a pretty solid outlook for equity markets this year. If I could show one more page on that, and then I'll take a pause here, John. We found that there is this level on interest rates where they become really detrimental to stock prices. And we're a bit of a ways away from that. Bottom line is this right here. Since the 2008 financial crisis, since interest rates have been really low, the level where interest rates rising starts to become a negative is not until about 3.6%. And we are below 2% right now on the measure used for this, which is the 10-year Treasury. So we've got a ways to go before bonds start to be a more viable option than equities to a lot of investors. We got a long ways to go before borrowing costs become too high for companies. So in other words, we're still in a decent spot here to be slightly overweight equities across most of JP Morgan. So John, let me pause for a second, check in on time. We can get a little bit more granular, but we could talk a bit about US equities and some spaces we like, or if there's anything on your mind that you want me to hit on here before I keep going, we can definitely do that.
No, that was excellent, Connor. Thank you. That's a great overview of where we stand and what we're looking forward to in the coming year or so. If I guess I would, for time purposes, I would open it for any questions now for Connor, not only on what he presented, but anything else that might be on your mind from an economic or investment point of view. And Connor, I got to give you credit. I'm looking at this guide to the market. It looks like there's 71 slides in there.
Yeah, there's a lot of slides.
And I'm sure you can expand on every one of them given the time. So I give you a lot of credit. And also one more thing before any questions pop out. So we listen to, well, let me restate that. We could listen to many different sources of information about the economy and investments and global outlooks and things like that. There are many different economists and investment analysts that we could listen to, but we're very selective as far as who we do utilize. And I can tell you one of the few economists that I personally follow is Dr. David Kelly. And David Kelly is, Connor, is his title the Chief Global Strategist?
That's right, yeah. Chief Global Strategist
for JP Morgan Asset Management. So it's not often that I miss one of his presentations because he really explains things in a down-to-earth manner. And so just having said that, Connor, it's it's great to have you guys on this side of the equation working with us. And with that, Lisa, any questions out there for Connor?
We have a couple that came in through email.
Okay.
The first you touched on a little bit regarding interest rates, but the question is, do you think we will ever see the high interest rates of the late 1970s again? Maybe not that high, but much higher than where we are today.
It's a really good question. Bottom line up front, we don't. If you look at this page, Lisa, and whoever the question came from here, you look back to the late 70s and early 80s, you had interest rates 15+%. We think you're in structurally a much lower interest rate environment for the foreseeable future. You could see rates have been falling here for 40 years. We don't expect that to change anytime soon. If there's one reason why, think about all the debt that we piled on in this country over the course of the last year. Right? The government piled on debt, and you could see the deficit really rose. The net debt really rose as the deficit shot up. Think about the impact of even a 2% spike in interest rates. That debt burden on the US government becomes almost too much to handle. So we think there's, that wall that used to exist between the Federal Reserve and government is broken down a bit, and you'll structurally have lower interest rates longer term.
Okay, thank you. Yeah. Anything else, Lisa?
The other question that came in is asking, I keep hearing about investments in emerging markets, and I think that means China and Russia. I don't trust a lot of what they have to say. Why would I trust what they tell us financially?
Again, that's a common question I get, Connor, at other get-togethers, client get-togethers. You can imagine some of the conversations that come up regarding China and Russia, but I mean, it is a valid concern, no?
Absolutely. Absolutely. I think so. I mean, now I'm not going to sit here and say that we need to think that all data is correct that we're getting from over there, because I don't think anybody can say that. But when you think about emerging markets, the story is all about the growth in the middle class and the long-term structural growth. And what you could see is some of the more important emerging markets, such as India, China, right? You could see that they're going to have massive growth from where we're at right now, which is the purple, over the next 10 years in their middle class. And China is even a similar story. Most people are really surprised that China is even an emerging market anymore, but it's all about the fact that there's so many lower income folks that are now moving into the middle class. And we think that's important because they want all the same things we do, right? They want new cars, new watches, new phone. They're going to be spending like crazy. and that consumer should drive a lot of growth. So from that perspective, we think it creates a nice longer term tailwind. Also always be a more volatile asset class. If we went back to that really colorful Callan chart that John and I showed there, that's an asset class that tends to be all over the page, maybe a smaller allocation within a diversified portfolio, but can pack a bit of a punch in terms of returns. So part of the reason why it's actually our highest expected long-term asset class. And if I could share one more thing super briefly on that. This is a heat map of global growth, and green is good, red is bad. You want this to look like your lawn in the spring. You don't want it to look like it did when COVID hit. And what you're seeing right now is a pretty good picture of global growth heating up. We're rebounding, we're on the upswing, and that tends to be a positive for not only emerging markets, which are really highly levered to global growth, but also places like Europe as well. And the benefit of owning those things is year to date too, right, John? I mean, you look at your emerging markets holding, it's about flat. And Europe has done much better too than the US.
That's right. That's right. Okay, good. So what I'm hearing there, Connor, is don't rely too much about what respective governments are spitting out. Look at the activity, look at what the people are looking to gain, what the companies are actually doing, and they're driving that type of growth.
Absolutely.
Yeah. Yep. Okay. Excellent. I'll wrap it up. And again, thanks very much for being here this afternoon. Really appreciate your time. Looking forward to the coming year and the continued guidance from JP Morgan Asset Management for sure.
Thanks so much for having me, John. And that was fantastic. Really enjoyed it.
Yeah.
Stay well, everybody. Stay healthy.
Thank you. Yeah, same to you. Thank you. And for everybody else on the call, thanks for hanging in there. Appreciate it. Again, any questions, you can certainly get in touch with us. You know how to do that. We're happy to help no matter what's on your mind. So again, thanks for attending, and we'll talk soon. Take care, everybody.
Thanks, John. Very helpful.
Bye-bye, everybody. You're welcome.